Hello everyone, my name is William Jackson, and in this project I will be presenting an interactive Tableau dashboard I developed using economic time series data. My analysis focuses on the federal funds rate and the 30-year mortgage rate, and the goal of this project is to tell a clear story about monetary policy cycles and how they relate to long-term interest rates. For this project, I used two datasets. The first dataset contains the federal funds effective rate, which comes from the Federal Reserve Bank of St. Louis, also known as the FRED database. It includes monthly observations going back several decades, and it measures the interest rate banks charge each other for overnight loans. This may seem like banks charging each other for their overnight loans doesn't really seem like it would affect anything, but this interest rate is what influences every interest rate in the economy. The second data set contains the 30-year fixed mortgage rate, which also comes from Fed. This represents the average lending rate for US mortgage borrowers. Both data sets are time series with a date variable and a single numeric value for the rate. I clean the data sets by checking for missing values, converting all data into a consistent monthly format, and loading both tables into Tableau for analysis. I chose these data sets because interest rates are central to understanding economic conditions, inflation, and housing markets. The Fed funds rate drives almost every financial product in the United States. By comparing it to mortgage rates, I can visually communicate how monetary policy affects everyday borrowing decisions. These data sets help support a strong visual story because interest rates move in cycles, and Tableau is excellent at showing long-term patterns, peaks, and turning points. The core question I wanted to answer is, how do changes in the federal funds rate relate to movements in long-term mortgage rates, and what economic cycles can we identify from the data? This question is important because financial decisions such as home buying, business borrowing, personal loans, auto loans, credit cards, interest rates are all influenced by interest rate policy set by the Federal Reserve. Understanding the timing and magnitude of these rate cycles helps us interpret broader economic trends. My storyline focuses on three major insights. First, the federal funds rate moves in clear cycles of tightening and easing. So I want to clarify what tightening and easing means. Tightening means that you are tightening credit conditions. You're making credit more expensive and harder to access, which means rising interest rates. Easing means you're easing credit conditions. You're making it easier to get credit, which means you're making credit cheaper by lowering interest rates. These cycles correspond to recessions, inflation periods, and major policy shifts. Second, mortgage rates follow the same general direction as the Fed funds rate, but not always at the same speed or magnitude. The lag between the two rates is one of the key insights shown in my dashboard. We will see this shortly. Third, the combined visualizations show the long-term borrowing costs respond to, but do not perfectly mirror short-term policy decisions. So in our first sheet, the Fed funds rate over time, this sheet shows the federal funds rate from the 1990s. Here we see our first bin on the left is 1994, going to the extreme right, we see 2025. I used a bar chart to emphasize the major peaks and declines. Right away, we can see three major tightening cycles. Again, tightening means interest rates are going up. The late 1990s, we have this very high rate. The mid 2000s, right before the housing crisis, and the post 22 inflationary period, when we lowered rates too much in 2020, and we had inflation that was very high, so we needed to aggressively raise interest rates. So if you look from 2003 to 2007, you see this very sharp, but it's over 4 years. And from 2021 to 2024, over 3 years, you see an even steeper rise. That's because the inflation was really, really much worse. We also see periods where rates fall to nearly zero, such as after the 2008 financial crisis, and again during the early stages of COVID-19. The reason the Fed does this is because when the economy is in a very bad position, you can raise GDP. The formula is C plus I plus G plus net exports, which is consumption and investment. If you lower interest rates, you raise investment. If you lower interest rates, that means you have more people taking out loans, which means more people buying stuff, which raises consumption. If you lower interest rates, you boost GDP. But you also, if you raise it too much, bring inflation, which means you had to raise interest rates after you just lowered them. So that's why we had to do it in times of economic distress, which is right after the 2008 financial crisis and again during the early stages of COVID-19. This chart communicates how the Fed responds to economic shocks by aggressively lowering rates and then slowly increasing them during recovery. Because if you increase them too quickly during recovery, you stint the growth of that recovery. So going to our second sheet, mortgage rates versus Fed funds rates. On this sheet, I combined the Fed funds rate and the 30-year mortgage on a dual axis line chart. Each line also includes a trend line to show the long-term direction. We can see that mortgage rates tend to follow the same direction as the Fed funds rate. Both rates hit historically low levels in the early 2010s. After 2022, both surged upward, reflecting the tightening response to high inflation. This lets us visually compare short-term monetary policy with long-term market consequence. And I just want to further illustrate the point that housing, the mortgage rates do not move as sharply and as dramatically as the Fed funds rate. And all you have to do is look at this linear trend line, and you'll see the slope is minus 0.9 for mortgage, and for Fed funds, it's minus 1.1. So challenges and how I overcame them. One challenge was aligning both data sets because they use different naming conventions and slightly different data structures. I fixed this by converting everything to monthly dates and ensuring consistency before analysis. Another challenge was designing a dual axis chart that remained readable. I adjusted line colors, removed the redundant grid lines, and added trend lines to help focus the story rather than letting the visualizations feel cluttered. Now we go to the dashboard. A final dashboard brings both sheets together to tell one unified story. The top view shows the historical federal funds rate cycle. The bottom view shows how mortgage rates moved in relation to Fed policy. Together, they create a narrative that connects policy decisions to real-world financial conditions. The interactive dashboard allows the user to hover over any point to see exact values. Here, compare peaks, and observe how the two rates converge or diverge, like I just showed you. And if you want to filter, there you can filter. In conclusion, this visualization highlights the relationship between monetary policy and household borrowing costs. By combining the Fed funds rate with mortgage rates, the dashboard shows how economic cycles evolve and how policy decisions influence long-term financial trends. Thank you for watching my presentation.